like gross profit. Now let's look at profitability ratios and something we call vertical analysis. Profitability ratios take different profit metrics from the income statement, like gross profit, EBITDA, EBIT, net income, and so on, and divide each by revenue, which is why we call it vertical analysis. Everything is being compared to the top line revenue number. Now, you may recall there are a few common synonyms for revenue. You may hear revenue referred to as sales or turnover. Now, we refer to these profitability ratios typically as margin ratios. For example, when we divide gross profit by revenue, we have the gross profit margin ratio. Often profit is omitted, and this ratio is simply called the gross margin. For all these ratios, the higher the percentage, the better. We can also compare individual expense lines to revenues as part of our vertical analysis. For example, direct operating costs divided by revenues, indirect operating costs divided by revenues, and so on. For these expense ratios, the lower the number, the better. Now let's look at how to analyze taxes and interest. One of my favorite tax ratios is the effective tax rate ratio. You simply take the total taxes on the income statement and divide it by earnings before tax on the income statement. Generally, this ratio shows how well a company manages its taxes. You can compare this ratio to the corporate tax rate in the jurisdiction or jurisdictions the company operates in. Here, a lower number is better. An alternative tax ratio is called the tax burden ratio. You can take net income and divide it by earnings before tax. You can think of this ratio as how much is left for shareholders after taxes. So, for example, if you see a percentage like 70%, this means shareholders are receiving 70% of earnings before tax, which also means 30% of earnings before tax is actually taxes. If you have already calculated the effective tax rate, you can quickly calculate the second ratio by simply taking 100% and subtracting the effective tax rate. Now let's look at analyzing interest expense. The first ratio calculates a business's effective interest rate. You need to make sure here and take the gross interest expense. Sometimes companies only show net interest expense on the income statement, which is where the interest income is netted off against interest expense. It's really important to make sure you use gross interest expense. If you can't find it or see it on the income statement, it can always be found in the notes to the financial statements. We divide this by total interest-bearing liabilities, which means finding all debt irrespective if it's current or non-current. When using figures from the balance sheet, such as interest-bearing liabilities, some analysts will look at averages over 2 years, especially if the balance sheet item moves significantly from year to year. For simplicity and to demonstrate the most common approach, however, we are going to use the current year balance sheet accounts rather than averages over 2 years. The second ratio analysts look at sometimes is the interest burden ratio. Here we take earnings before tax and divide it by earnings before interest and tax. So if you get a number, let's say like 65%, this means earnings before tax is 65% of EBIT, or that 35% of EBIT is eaten up by interest expenses. Now we're going to complete our profitability and our expense ratios. I'm going to show you a couple of things in Excel that we purposely included to make sure our model is robust. And those are extra redundant checks, and we'll talk through those in a second. It is vertical analysis, so we're going to see revenue repeat and repeat. So we're going to link revenue only once and then copy down in a similar way to what we did with net income. Okay, so our first profit margin is gross profit over revenue. So I'm going to go plus, control page up. I need to go right to the top because we're all talking about the income statement. And our gross profit is row 10. And our revenue is the very top, row 8. Okay, now what I'm going to do is copy that across. And before we move on, I just want to explain how I like to think about this ratio when I'm looking at it. Now, I encourage you to use the currency of your country or jurisdiction. I'm going to talk about it in dollars since I'm based in North America. So the way you read a gross profit margin ratio or any of these ratios is out of $1 in revenue, how much is left after paying direct operating costs, cost of goods sold, for example. And here we see this retailer gets about 26 to 27 cents after it covers its direct operating costs. Now, let's go back, and I'm just going to link revenue above, and we need to find our SG&A. So control page up. Our SG&A is here, and you're going to see this appears as a negative number. In ratio analysis, we turn everything into positives. So I'm going to put a little negative sign in front of this. Some folks like to multiply it by -1, and we'll do the same thing. And we're going to copy that across. Now this is an expense ratio. And the way we read this, and I'll scroll across, is for every dollar in revenue, how much is going to cover our selling, general, and admin expenses? And you can see roughly 20 cents of every dollar goes to cover our indirect operating expenses. Okay, now what we're going to do is we're going to have other operating expenses in revenue. I'm going to put a plus and a minus sign because I want this, it's going to be an expense that I need to make a positive number. Control page up. There's my other in row 14, 451. Copy that across. And then what we're going to do is we have our next profit metric. And we're going to take revenue. We need to find EBITDA. EBITDA is row 15. I'm going to copy this across. Okay, so let's talk about EBITDA, and you'll also see our first redundant check. And I'll explain why it's there. It's to give you and any other user of the spreadsheet confidence that the model is working robustly. So what we have here first is interpreting the EBITDA margin is for every dollar in revenue, this retailer generates between 4 and 7 cents of EBITDA. So you can see it dramatically dropping. What is the check? Well, what we want to make sure is that our gross profit less our SG&A expense and our other operating expense should come to the same ratio, and it does. And if it didn't, we'd get an error message. So I'm just going to delete this cell for a second. You get the error message. Control Z or Control Z to get that back. Okay, so now let's keep going. We have our revenue. We then have to put a plus and a minus sign, control page up. We need depreciation. Copy that across. Then we have our EBIT and revenue. Control page up. Where's my EBIT? It's in row 19. Control R. You'll see there's another check. Let's just make sure it is saying okay. How did we get that check? Well, we want to make sure that if we take EBITDA margin and subtract that one expense line, we're getting our EBIT margin. Okay, and we can keep going. So I'm going to have to put a minus sign in here. I'm going to go, and here we have interest expense and interest income, and we're going to minus both of them. So you need to minus row 22 and row 23. So you should get 2348. We already know revenue. We can copy that across. Then we have our earnings before tax. Let's get that revenue in. Earnings before tax is row 24. Or keep using Control R. There's our other check. What are we doing here? We're just saying, is our last profit metric minus this expense line, it should equal our new profit metric. And 5.5% minus 0.48, I guess there's a rounding in there. It does say okay, so we're good to go. Now, we also have a few extra ratios that we need to calculate that are really useful to understand how a company is operating. When we look at tax over revenue, that's going to be another vertical. I'm going to put a minus sign because tax is typically an expense, but not always. Copy that across. And then we're at the bottom of our vertical analysis. Now, net income we already have. So I'm going to go to net income, and then we have revenue. And you can see our errors are turning to OKs, so we know we're calculating those correctly. And let me just dwell on this for a bit. Okay, I'm just going to highlight this one cell here. How do we interpret net income or net profit margin? Same story. For every dollar in revenue, what's left for shareholders? Well, roughly 3 cents is left for shareholders at the end of all those other expenses. Now, we still have a few more ratios to do. And I'm going to scroll down. We have the effective tax rate, the tax burden, the effective interest rate, and the interest burden. And then we're done. So here we're going to have to, look, we already have the tax number. And we already have the earnings before tax. We're going to copy that across. Control R. And what we're saying here and why it's useful is, well, this big retailer operates in 30 countries. So this should be the blended tax rate that they're paying. Now, if this company were only to operate in one country, we would compare this rate with the effective corporate tax rate that we know, or the published corporate tax rate. So here the company pays about 30 cents on the dollar in taxes, or 30 cents on its earnings before tax. If the tax rate, for example, in your country was 25% and you only operated in that, that would be your benchmark. We'd say, oh, this company for some reason is paying more tax than it should. I wonder what's going on with its management of taxes. Let's do the tax burden. The tax burden, we already have these metrics. It's net income and our earnings before tax. Control R. This one we have to be careful about. We do have our interest expense, but we combined our interest income and our interest expense. So we're going to have to go to the financial statements because I only want the gross interest expense, because that will give me a real sense of what the company is paying as a percent. So there's 2461. And then we need our total interest-bearing liabilities. So we want to know exactly, not all liabilities, but what's the interest we're paying on our interest-bearing liabilities. So we're going to go to the financial statements again. Page up. And I'm going to take it from way down at the bottom where we have that calculation. Total interest-bearing liabilities, that's row 124. I'm copying that across. Control R. Let's look at this. We can see that its effective tax rate is quite low, ranging from about as high as 4 and a bit to as low as 2.5. Great. And then our last one, we already have all the numbers we need, earnings before tax, and then our EBIT. We can just scroll up. Okay, and then we can copy that across. Control R. Okay, congratulations. We are done. Our checks are all saying okay. So if you feel comfortable, feel free to go right to small retailer. If you want some extra practice with me, join me for mid retailer. Okay, see you shortly. Okay, let's do some more practice. If you don't need it, remember you can skip this, just hit continue and go to small retailer and test yourself. Okay, so what we're going to do is the same thing. We need to mainly stay at the top of the financial statement worksheet because we're looking at vertical analysis, which relates to the income statement. And we're going to go find control page up. I need to go page up. Let's get to the top here. And we're going to take our gross profit, which is row 10. And we're going to get our revenue. And we're only going to link revenue once, which will speed things up and minimize errors. Control R. And then we're going to go revenue, and I'm going to do something different. I'm just going to keep linking it. Speed things up. And I don't have to think about it. You can see why this is called vertical analysis, because the denominator is the same. And we are good. Okay, now let's do our SG&A. Remember, we have to put a negative sign and then control page up, or you can multiply it by -1, your preference. And there's our 10,899. And then I'm going to go to other operating expenses. I'm going to put a negative sign, and that's 63 in row 14. Then we have our EBITDA. You can see I'm doing it slightly differently, and I'll show you why in a second. Then we have our depreciation. It's expense. Put a negative sign. Then we have our EBIT. It's a profit, so we don't have to worry about a negative sign. Here's our EBIT. Then we have two things we have to subtract here. Interest expense and interest income. So minus interest expense and minus interest income. Then we have our earnings before tax. Then we have our tax, which is a negative. So we put a negative sign there. The tax line is row 27. And then we have net income, and I'm just going to link that to above. Okay. Now, generally, I will do it this way, and I'll tell you why. So then I can just do this, highlight this whole area. Right? And then highlight across, and then do Control R. So it just speeds things up. We can have a look, make sure the OKs are there. And later on in this course, we're going to benchmark the margins of mid-retailer with big retailer and small retailer. But for now, let's just make sure the OKs are all there. We're good to go. And then we just have 4 more ratios we have to calculate. And that's our effective tax rate. We already have the tax above. And we already have the earnings before tax. And we have our interest expense. Now, we think we do, but we actually combine interest expense and interest income. We need to be more precise here. So we're going to go minus. We're going to go control page up. And I just want that one line, row 22. And same with interest-bearing liabilities.
Now calculate some of these ratios
specific
in
number.
Excel.
We haven't linked to it before, so I'm going to go control page up. And I'm going to go right to the bottom. And you're going to see total interest-bearing liabilities are disclosed here in row 124. And then we have earnings before tax divided by EBIT. We do have EBIT above. Okay, and again, why am I doing it this way? Because what I can do is just go like this, Control R. And we're done. Now it's your turn. Try it again with small retailer and enter your answer. Bye for now.